Hello. Now, we are going to be finishing up in these last two videos financial statement analysis. This is class 41 video A. If you're in the Monday, Wednesday, Friday class, this is class 27 video C if you're in Tuesday, Thursday classes. So we've already talked about horizontal analysis and vertical analysis. And now we're going to talk about some specific ratios that we use when analyzing financial statements. Alright, so up till now, at the end of each chapter, there's been a ratio of some kind, so a lot of these you'll have seen before. We're just going to bring them all together in one chapter. Alright, so suppose you want to compare some companies. Recent earnings histories, for example, you might want to compare companies' returns on stockholders' equity. Remember that no single ratio gives the whole picture of any company's performance. Different ratios explain different aspects of a company. The ratios we discuss in this chapter may be classified and used for the following purposes: evaluating the ability to pay current liabilities, evaluating the ability to sell merchandise inventory and collect receivables, evaluating the ability to pay long-term debt, evaluating profitability, evaluating stock as an investment. So you may recall we've seen ratios that do these things at the end of each chapter. Depending on what we're talking about in the chapter, we look at a ratio associated with the items from that chapter. So now we're just sort of going to go over all the ratios at once. If you look in your book at the balance sheet in Exhibit 15-7, you'll see it's a comparative balance sheet, and it's got 2 years. So whenever we say comparative, it's so you can compare something. Typically it's two. A lot of times you'll see 3 years reported on a balance sheet. And so we can compare 2 years, 2017 and 2018. On the past videos, we did things like common size them. We did things like do horizontal, so you can see the change from year to year. So now we're going to use these numbers to calculate certain ratios that give us information. So we're going to look at these numbers from this balance sheet and calculate ratios. Alright, so we're going to use this income statement also, right? So some of the ratios involve revenues and expenses, some ratios involve assets, liabilities, and owner's equity, and so we need both the balance sheet and the income statement. So this has the same 2 years, 2018 and 2017. So now we can take various components from these financial statements, turn them into ratios by dividing one number by another. It'll give us information. All right. So one thing that's super important is, can you meet your current liabilities, right? Because if you can't pay your debts on time, you're going to get behind with the bank, you're going to get behind with bondholders, and they'll come and want to, foreclose on you, take your stuff, whatever their security is. So you want to be sure that you are always able to meet your current liabilities. All right, so there's a ratio that we use called working capital, and it tells us if we're covering our current liabilities or not. So it's a good starting place to think about a company's ability to pay its current liabilities. Working capital measures the ability to meet short-term obligations with current assets. So if we needed some liquid assets, could we cover what we need to right away? So we call that working capital, right? It's your capital that you're using as you're going through day-to-day work. So working capital is just current assets minus current liabilities. So you go to your balance sheet, and for each year you can calculate that. So in 2017, their working capital was $110,000. In 2018, their working capital was $120,000. So they had a little more working capital as they go on, and that's a good thing, right? The more working capital you have, the better you're able to cover your current liabilities. Another number we use to see how well you can cover your current liabilities is called the current ratio. And it's the most widely used ratio, and it's the current ratio. Current ratio measures the company's ability to pay its current liabilities from current assets. So to calculate this ratio, you take total current assets divided by total current liabilities. So you just go to your balance sheet, you get those two numbers, divide assets by liabilities, and the higher the number, the better you're able to meet your normal business hours. So think about that. If your assets are bigger than your ratios, that number is, if your assets are bigger than your liabilities, that ratio is going to be 1 or more, right? Because the top number is going to be bigger than the bottom number, so you'll get 1 point something. So that means you're at least covering it. If it's 1 or more, you're covering it. So a high current ratio indicates you have sufficient assets to maintain normal business operations. What is an acceptable current ratio? Well, the answer depends on the industry. The norm for companies in most industries is about 1.5, as reported by the Risk Management Association. So as long as you're 1, your current assets equal to your current liabilities, you got no cushion, right? But at least you're covering them. If you're less than 1, you can't cover them. That's really bad. So it should be about maybe 1.5, 1.5 times. So that just means a 1.5 current ratio means your current assets are 1.5 times your current liabilities, so you're covering them. Okay, next, cash is king, so there is a cash ratio. Cash ratio helps determine a company's ability to meet its short-term obligations. So that's important because you actually pay back your liabilities with cash, right? Now, yes, you can liquidate your merchandise inventory and you can sell your investments and things like that, but you actually pay those liabilities to the bank or to bondholders using cash. So you want to get really specific about how well you can cover current liabilities. Look at cash. Cash is an important part of everyday business. Without adequate supply of available cash, businesses cannot continue to operate. Businesses therefore monitor cash very carefully. One measure that can be used to calculate a company's liquidity is the cash ratio. The cash ratio is a measure of a company's ability to pay current liabilities from cash and cash equivalents. Cash ratio equals cash plus cash equivalents divided by total current liabilities. Notice that the cash ratio includes cash and cash equivalents. As a reminder, cash equivalents are highly liquid investments that can be converted into cash in 3 months or less. So things like prepaid rent is not really liquid, but investments in the stock that's traded on the stock exchange, you could sell that right away. So that would be liquid. All right. Another ratio that tells us about how well we can cover our current liabilities is the acid test or quick ratio. So the acid test ratio, sometimes called the quick ratio, is the ratio of the sum of cash, cash equivalent, short-term investments, and net current receivables to total current liabilities. This ratio, sometimes called the quick ratio, tells whether the entity can pay all its current liabilities if they come due immediately. So cash, cash equivalent, short-term investments, net current receivables. So typically current receivables become cash pretty quickly as customers pay you off, divided by total current liabilities. This is this other idea that what we have in cash right now, plus anything that can pretty quickly within the next month turn to cash, right? So the cash ratio, right? The cash ratio is what could we basically turn into cash right now, which is cash and cash equivalents. Acid test ratio is what can we turn into cash within a month, right? Because usually you don't have to pay your current liabilities that day. You have a little time to scrape together the cash. So it's the same idea. Divide by total current liabilities, just like all of them. And you'll come up with some ratio, and it tells you how well you can cover your debts. So if you look at our example company, in 2017, they had a 0.93, and in 2018 they had a 1.01, so they're getting better over the years, and they're better than the industry average, which is 0.46. So in other words, they can cover their liabilities quite well. So that is evaluating current liabilities. So you'll notice that current liabilities was the denominator on all of those. you're measuring current liability coverage. Now on this, next we're going to talk about the ability to sell merchandise and collect receivables. So we're going to have some slightly different ratios, but what they're measuring is how you're doing at selling stuff and how you're doing at collecting the money when you sell stuff. Alright, so there's 5 ratios that measure your ability to sell merchandise. It's inventory turnover, which is how many times you sell the average inventory during a year. Days sales in inventory measures average number of days that inventory is held. Gross profit percentage measures the profitability of net sales dollar above cost of goods sold. Accounts receivable turnover, number of times a company collects the average receivables balance in a year. And days sales in receivables, this ratio indicates how many days it takes to collect the average level of receivables. So let's look at these individually. Inventory turnover. So think about it. If you are interested in seeing how a company's doing and they have merchandise inventory, wouldn't it be important to know how well that stuff's selling? Right? Is it like old inventory sitting around? Does it sell pretty quickly? How are they doing with selling it? So the inventory turnover ratio measures the number of times a company sells its average level of merchandise during a period. So to calculate this, you use cost of goods sold divided by average merchandise inventory. A high ratio means it's easy to sell, and a low ratio indicates difficulty. So if you look at this example company in 2018, their cost of goods sold for 2018 was $513,000, which you got from that income statement. All right, if you look at that income statement, you'll see that in 2018 it was $513,000, and then they take the average merchandise inventory, which is the beginning and ending merchandise inventory. So if you go to the balance sheets, right, and you get the 2017, which is 111, and the 2018, which is 113, and you divide that, you add them and divide it by 2, that's your average inventory for the year 2018. So you come up with 4.58. They don't sell their merchandise all that quickly. If the industry average is 27.7, they're not turning it over a whole lot of times per year. Now that could be that their particular company doesn't do that much sales, they do more service or something, but that's not looking good for them if they're 4.58 and industry average is 27.7. The next thing, days sales in inventory. So days sale and inventory ratio measures the average number of days merchandise is held by the company. So when you buy some merchandise and stick it in your warehouse, how long does it sit around in the warehouse? Right? So you do that by 365 days divided by inventory turnover. So our inventory turnover was 4.58. So you take 365 divided by 4.58. How many times does it turn over? And you end up with 79.7 days. So 80 days. When you buy something, it sits around for 80 days. That's a long time. It takes up space. You have to insure it. 80 days, things can break or spoil and go obsolete. So that's a long time. That wouldn't be great, especially when industry average is 13 days. All right, so that 13 days was 365 divided by 27.7. So they're not doing as well as the rest of the industry in terms of how they're selling stuff, how quickly they sell it. Now, gross profit percentage measures the profitability of each net sales dollar above the cost of goods sold. So to calculate that, you take gross profit, right, which comes straight from the income statement, gross profit, and you divide it by net sales revenue. So that's just telling you what percentage of your sales revenue is gross profit. So gross profit divided by net sales revenue for our example, 345 divided by 858 equals 40.2%. Industry average is 43, so they're doing pretty well. Even though they don't sell their stuff as fast, when they do sell it, they make a good profit margin on it. So that's doing a little better. So they're earning a good profit on it when they do sell it. Next, accounts receivable turnover. So if you sell stuff on account, that's great. You might sell more because you're giving people credit, and when they don't have cash, they can still purchase your product. However, you have to make sure they actually do pay the cash eventually. So accounts receivable turnover measures the number of times the company collects the average receivables balance in a year. So to measure that, you take net credit sales, so you have to take your net credit sales and divide it by average net accounts receivable. The higher the ratio, the faster the cash collections. However, a receivable turnover that is too high may indicate that credit is too tight, leading to a loss of sales to good customers. So you have to kind of think about this in terms of the more credit I give, the more I will sell. But when I give credit, I have to give it to people who I know will eventually pay me. So if my number's too low, it could be I'm not selling as much as I could because I'm not giving as much credit. So that's an interesting number. And finally, we have days sales in receivables. So it's kind of the same idea. It's the sales receivable is the ratio of average net accounts receivable to 1 day sales. The ratio tells how many days it takes to collect the average level of receivables. So you take that accounts receivable turnover ratio and that we just calculated, and you divide it into 365 days. So 365 days divided by 8.6 equals 42.4 days. Industry average is 25 days. The shorter the collection period, the more quickly they can use their cash. So you want to turn those receivables into cash, but not so quickly that it means you're not giving enough credit. All right, so we're almost there. We're going to talk about a few more sets of ratios on the next video.